Have you ever heard of the term IRMAA? Most people haven't. But if you're on Medicare or getting ready to start Medicare, IRMAA can take a big bite out of your Social Security check in retirement. And here's the worst part. Many retirees don't even realize it's happening until it's too late. In 2025, with rising and new income thresholds in place, IRMAA is more important than ever to understand. My name is Brad Pistole, and I'm an income-related monthly adjustment amount certified planner and a retirement income certified planner. And I'm dedicated to helping people retire all over this great country. If you'd like to see what my team and I would propose for your retirement income plan, just reach out to us at the contact information below. So just what exactly is IRMAA? Well, let's start with the basics. IRMAA stands for Income-Related Monthly Adjustment Amount. It's an extra surcharge that some retirees pay on top of their regular Medicare Part B and Part D premiums. So think of it like this. Medicare premiums are set at a base amount that most people pay. But if your income is above certain thresholds, the government says you can afford to pay more, and they tack on IRMAA surcharges. So IRMAA is essentially a tax on higher income retirees, though it's technically structured as a premium adjustment. Now let's talk about how IRMAA works. Here's where it gets really tricky. IRMAA isn't based on your income today, it's based on your income from 2 years ago. That means your 2025 Medicare premiums are based on your MAGI from 2023 in that tax year. If you had a big income year in 2023, maybe because you sold a business or you cashed in some retirement accounts or realized some capital gains, then in 2025, you could get hit with much higher Medicare costs. And we're not talking about small numbers here. These surcharges can add up to thousands of dollars per year per couple. So let's take a look at the updated 2025 numbers. Medicare sets specific income brackets each year, and depending on where you fall, your premiums can go up. For 2025, this is the way it works. If you're a single filer and your modified adjusted gross income, known as MAGI, is under $106,000 for the year, you'll just pay the standard Part B premium. If you're married filing jointly, that threshold is increased to $212,000 combined. But if you cross these thresholds by even $1, you'll find yourself in IRMAA territory. And the surcharges rise in steps. The first tier adds about $70 to $80 extra dollars per month per person. But higher tiers can raise premiums by hundreds of dollars per month per person. Now, at the very top, if you fall into the highest IRMAA tier, retirees can pay over $15,000 a year in additional Medicare premiums for a married couple, simply because of IRMAA. So this isn't pocket change. It's a serious cost that can erode your retirement income if you're not planning for it. Now, I hear this all the time. You might be thinking, Brad, I don't make that much money in retirement. Why should I even care? Well, here's the problem. IRMAA isn't just for wealthy retirees. With required minimum distributions, Social Security income, pensions, and investment gains, many middle-class retirees can accidentally push themselves into IRMAA territory. And in 2025, with higher inflation, rising Social Security benefits, and market volatility, more retirees are getting bumped into higher brackets without even realizing it. So let's talk about an example. Let's say you and your spouse have a combined income of $200,000 for the year in retirement. You're under the $212,000 threshold for 2025, so you're safe. But one year you take an extra $25,000 distribution from your IRA to renovate your house. Suddenly, your income is now $225,000 and you've entered IRMAA territory. That could mean thousands more in Medicare premiums over the next year. So what are the landmines that push retirees into IRMAA? Here are some of the big ones. Required minimum distributions, known as RMDs. You see, once you hit age 73, RMDs can inflate your taxable income and trigger these surcharges. Here's another one, capital gains. Selling stocks or a rental property or even land can bump you into a higher bracket. Here's another one, one-time income events. Things like cashing out an annuity, selling a business, or even winning the lottery. How about Social Security taxation? Remember, up to 85% of your Social Security benefits can count as taxable income, which feeds into IRMAA calculations. And all of these things can catch retirees off guard, especially if they're not planning around these brackets. Now let's get into some of the good news. There are strategies to manage or even avoid IRMAA altogether if you plan carefully. Here's one way: Roth conversions at the right time. Doing Roth conversions in your early 60s before Medicare starts can lower your taxable income later in life, helping you avoid IRMAA in your 70s and beyond. Here's another one: timing your distributions. If you'll know you'll have high income in one specific year, you may want to spread withdrawals over multiple years instead of taking one big lump sum. Tax-efficient investments. Using municipal bonds or other tax-free income sources can help keep your modified adjusted gross income much lower. Now, there is an appeal process. If your income dropped due to a life-changing event like retirement, divorce, or the death of a spouse, you can actually appeal IRMAA with Social Security. Many people don't realize this option even exists. Let me give you a simple story to tie this all together. I recently spoke with a couple who retired in 2022. In 2023, they sold a rental property and realized a $300,000 capital gain. Now, they didn't think much of it because they weren't working anymore and they thought their income was low. But now, fast forward to 2025, Social Security hits them with a huge IRMAA surcharge. If they had spread that sale over multiple years or used a 1031 exchange, they could have avoided most of that surcharge. The key with IRMAA is proactive planning. By the time you see the surcharge on your Social Security check, it's too late to fix it. Because remember, it's based on income from 2 years earlier. So the decisions you make in 2023, 2024, and in 2025 are going to affect your Medicare cost in 25, 26, and 27. This is why retirement income planning isn't just about investments. It's about taxes, healthcare costs, and coordinating everything so you don't pay more than you should. So let's wrap this up. IRMAA. It's the income-related monthly adjustment amount, a surcharge on Medicare premiums for higher income earners. And this can really affect retirees. It's based on your income from 2 years ago, not from this year. In 2025, with updated brackets, more retirees than ever will get hit with these costs. It's estimated that more than 6 million people will be affected by this in 2025. But with smart planning like Roth conversions, careful withdrawals, and tax-efficient strategies, you can reduce or even avoid IRMAA. So don't let a surprise Medicare bill eat away at your retirement income. You need to plan ahead, and you'll keep more of your hard-earned money in your own pocket. Hey, thanks for watching. If you found this video helpful, give it a thumbs up and subscribe so you don't miss future updates. And remember, my team and I at the Ozarks Retirement Group would love to show you what we would propose for your retirement income plan. Just reach out to us at the contact information below. Take care, and I'll see you in the next video.